Hi, welcome to Bite-Sized Accounting and Auditing. Imagine you own a custom furniture workshop. One client walks in and wants a beautiful hand-carved dining table. Another client orders 50 identical office chairs for a company. Or think about an accounting firm that provides customized tax planning, audit services, or consulting projects for different clients. Here's the big question every business owner and accountant faces. How do you know how much each job costs and whether you are actually making money or losing money on that specific job? That is where job order costing comes in. Job order costing is the costing system used when a business produces unique, customized products or services for specific customers. Every job is different. Every customer has different requirements. You cannot simply average the costs across all jobs. Instead, every job gets its own job cost sheet. Think of the job cost sheet as a mini financial report for one specific job. It tracks the costs assigned to that job from start to finish. There are three key cost elements we track on every job cost sheet. First, direct materials, or DM. Second, direct labor, or DL. Third, manufacturing overhead, or MO. Let's break each one down with real examples. Direct materials are materials you can physically trace directly to the job. For example, if you are making a custom dining table, direct materials may include the special wood, high-quality stain, and custom hardware used only for that dining table. These materials are easy to connect to that specific job. Direct labor is the cost of the employees who physically worked on that specific job. For example, your skilled carpenter spent 35 hours carving, sanding, and assembling the table, and you pay him $28 per hour. Because that worker's time can be traced directly to the dining table, it is direct labor. Manufacturing overhead includes the indirect production costs that support the work, but cannot be traced easily to one specific job. Examples include workshop rent, utilities, supervisor salary, depreciation of tools, and small supplies like glue or sandpaper used across many jobs. These costs are real production costs, but they are not easy to trace to one specific table or one specific chair. That is why companies use a predetermined overhead rate. Now, let's walk through a complete real-world example together. You are building a custom dining table. Direct materials equal 1,850. Direct labor equals 35 hours times $28 per hour, which equals $980. Now comes the part most students find tricky. Manufacturing overhead. Companies do not usually wait until the end of the year to know the exact overhead cost for each job. Instead, they use a predetermined overhead rate. The predetermined overhead rate is calculated before the period begins. The general formula is estimated total manufacturing overhead divided by the estimated activity base. The activity base is the measure a company uses to apply overhead to jobs. Common activity bases include direct labor hours, machine hours, or direct labor cost. In our example, the activity base is direct labor hours. Estimated total manufacturing overhead is $300,000. Estimated direct labor hours are 20,000 hours. So the predetermined overhead rate is $300,000 divided by 20,000 direct labor hours. That equals $15 per direct labor hour. This means that for every direct labor hour used on a job, we assign $15 of manufacturing overhead to that job. Now we apply overhead to the custom dining table. The table used 35 direct labor hours. The predetermined overhead rate is $15 per direct labor hour. So applied overhead equals 35 hours times $15. That gives us $520 of applied overhead. Notice the word applied. Applied overhead means the overhead assigned to a job using the predetermined overhead rate. Now let's add everything together. Direct materials, $1,850. Direct labor, $980. Applied overhead, $525. Total job cost equals $3,355. If you sell the table for $5,800, profit on this job equals $5,800 minus $3,355. That gives you a profit of $25,245. And that is the power of job order costing. It helps a business see whether a specific job made money or lost money. Let's do one more example. A company orders 50 identical office chairs. For this job, direct materials are $4,000. Direct labor is 120 hours times $25 per hour, which equals $3,000. We will use the same predetermined overhead rate of $15 per direct labor hour. So applied overhead equals 120 hours times $15. That gives us $1,800 of applied overhead. Now let's calculate the total cost of the office chair job. Direct materials, $4,000. Direct labor, $3,000. Applied overhead, $2,800. Total job cost equals $8,800. Since the job includes 50 chairs, the cost per chair is $8,800 divided by 50. That equals $176 per chair. Now the business can use that information to set a selling price, evaluate profit, and decide whether the job was worth accepting. Now let's talk about one important final step. The overhead we assign to jobs throughout the year is called applied overhead. It is calculated using our predetermined overhead rate and the activity base. In this example, our activity base is direct labor hours. But at the end of the year, the company adds up all its actual overhead bills, the real rent, real utilities, real supervisor salary, depreciation, and other indirect production costs. Often, applied overhead and actual overhead do not match. If applied overhead is less than actual overhead, overhead is underapplied. That means our jobs in total were undercosted. If applied overhead is more than actual overhead, overhead is overapplied. That means our jobs in total were overcosted. Now, how do we account for the difference? If the underapplied or overapplied overhead amount is immaterial, it is usually close to cost of goods sold. But if the amount is material, it can be allocated among work in process inventory, finished goods inventory, and cost of goods sold. The goal is to make sure the company's financial statements reflect the true cost of production. Let's see how this works. Remember, our predetermined overhead rate is $15 per direct labor hour. Let's say at the end of the year we find that workers logged a total of 20,500 actual direct labor hours across all jobs. So the total overhead we applied to all jobs is 20,500 hours times $15. That equals $307,500. Now let's compare this to our actual overhead costs. Scenario 1, our accounting department tells us the actual overhead for the year was $310,000. We applied $307,500, but the actual cost was $310,000. We did not apply enough. Overhead is underapplied by $2,500. Scenario 2, what if the actual overhead was only $295,000? We applied $307,500, but the actual cost was less. We applied too much. Overhead is overapplied by 12 off the 500s. Just remember, you compare what you applied during the year to what was actual at the end of the year. If applied overhead is less than actual overhead, it is underapplied. If applied overhead is more than actual overhead, it is overapplied. So let's bring it all together. Job order costing helps a business track the cost of each specific job. The job cost sheet includes direct materials, direct labor, and applied manufacturing overhead. The predetermined overhead rate helps the company assign overhead to jobs before actual overhead is fully known. And at the end of the period, the company compares applied overhead with actual overhead to determine whether overhead was underapplied or overapplied. That is how businesses know what each job really costs and whether each job is profitable. If this video helped you understand job order costing, drop job order in the comments below. Think of one business in your own community where job order costing would be useful. Tell me in the comments. Like the video, subscribe, and turn on notifications. We are building a complete cost accounting series. Thank you for watching, and I'll see you in the next one.